Well, this is Current Yield, Grant's Interest Rate Observer of the Year. I'm Jim Grant, and with me, as always, is the great Deputy Editor of Grants, Evan Lorenz. Henry French, as per usual, at the control panel. And joining us today is none other than Douglas Cifu, the Chief Executive Officer of Virtu Financial. And Doug will be getting to you in just one moment. But Evan, Elon Musk is never won Entrepreneur of the Month here at Grant's Interest Rate Observer. Is that correct?
Long-standing for at least 5 or 6 years.
Yeah, I think he's. I thought that his comment on working from home is pretty fabulous. You could quote or semi-quote. You can pretend to work someplace else. That was okay. But you sent me something more, and there was kind of that it leads me to think that there might be a traffic jam of people returning to their Tesla offices.
Yes, Elon Musk apparently submitted a memo to his employees saying that about 10% of them might get the pink slip.
Did he say who? Did he name names, or just let the impression settle in? Let it marinate in the staff. I would just let it marinate myself. Just might quicken the pace of work, shorten the time in the water cooler. Just a little more starch in the organization.
I'd guess probably the later.
Yeah. So as I said, CEO of Virtu Financial is with us today, Doug Cifu. Doug, I'm going to parenthetically pause. Am I pronouncing Cifu correctly, or am I bungling?
You are doing a great job.
Okay,
yeah,
so
Cifu.
far.
My grandmother used to say Cifu, but we Americanized it. So yeah.
See, okay. Doug is by training and long-standing as a lawyer. He was a partner at Paul Weiss, Rifkin, Wharton, and Garrison, M&A lawyer of many deals and great professional recognition, and a proud Columbia University Lion, Phi Beta Kappa Law School, and I think by extension, Doug, a fan of the Ivy League champion Columbia Lion baseball team. Am I correct?
I'm a huge fan. Yeah,
okay.
It's our best team sport.
Yeah,
well done, Jim.
Just wanted to get that out.
Yeah.
But Evan, you organized this fabulous podcast, and I'm going to give you the honor of, to continue the baseball metaphor, of lobbing in the first lollipop. We'll get to the hard stuff later. Yeah, I've got a slider or two, but Evan has a question for you. So Evan, commence fire.
Yeah, so this popped up in the news last week. An ICE executive at an industry event said that one of their major clients almost defaulted on an exchange in March of 2020. And that stood out to me because a lot of the post-financial crisis regulation over the last decade has been trying to move more and more traded products into central counterparties like ICE. But if there was almost a major default in March in 2020, that kind of speaks to more fragility in the system than I think a lot of people expect. What almost happened then, and have the problems that led to a near default on a major exchange been fixed, or is this something that might be a potential problem, in the coming cycle?
Yeah, that's a great question, and thanks very much for having me. And that is a little bit of a slider. I like it. You guys are throwing it right out there. I mean, to be honest, I'm not familiar with the details. It wasn't Virtu Financial. The concept of mutualizing as opposed to having bilateral risk in a system from my perspective, is clearly the superior way to deal with trading risk, right? I mean, a lot of the issues from the financial crisis of 2008 was really the bilateral nature of a lot of swaps and CDS products and things like that. And so a lot of that risk has been mutualized. You saw the impact, and I think the power of mutualization with what happened to Robinhood in January of 2021. I mean, their issue was that they got overextended, if you will, on behalf of their customers with the equities clearinghouse known as the NSCC. And really, the NSCC did a wonderful job there because they basically said, listen, you don't have enough capital. We're not going to shut you down. We're going to allow you to take de-risking trades and give you the opportunity to go raise additional capital, which Robinhood did very successfully, and they got back on their feet. And there's obviously been a lot of urban legends about and conspiracy theories about what happened there, but actually the system worked incredibly well. And if that risk had been, and they were one of our largest customers, right? And so the issue of whether or not we were exposed to Robinhood as a counterparty, right, because they're sending us their order flow into other firms as well, that was effectively taken off the table because the NSCC took this action and said to Virtu and to the rest of the equities marketplace, we got it. We got this under control. You don't have to worry. You can keep doing business with Robinhood, and you can keep trading on exchanges, et cetera. And the market functioned in a very fine, fluid fashion as a result of that. So I would argue that mutualization of risk and clearinghouses, properly constructed and properly capitalized, make a lot of sense. On the contrast, I mean, what happened out in Asia on the LME with regard to nickel and whatnot, when they busted a bunch of nickel prices, and apparently there was a significant margin deficiency there. That's exactly how markets shouldn't operate. You can't just allow trading to happen for 3-4 hours and then say, oops, it didn't really happen. So, there's good examples and there's bad examples, but I do think ultimately mutualization and clearinghouses make a lot of sense.
Doug, Virtu is like ubiquitous. I see that equities, commodities, currencies, options, fixed income, 230 exchanges, and in more countries than are members of the United Nations. That's my understanding of the scope of the business. So you are, I would suppose, an advocate of price discovery and freely. Okay. We have been living for the past dozen or so years in a regime of interest rate suppression. Interest rates, now I'm talking my book as the owner of Grant's Interest Rate Observer, the most important consequential prices in the world of finance. And we have been living in a world of suppressed and manipulated and generally unauthentic critical prices. So now the Fed is proposing to kind of get with the program and align its administered rates with the more or less discovered rates that are prevailing elsewhere in many of the markets in which you operate. What do you suppose is going to be the consequence of the realignment of rates with something like reality after a dozen years worth of make-believe?
Yeah, it's a great question. And just to take a step back, I mean, that is what Virtu is all about, which is about, we describe ourselves as a global automated electronic market making firm, and the whole concept behind Virtu is let's be agnostic to markets and direction of markets and try to figure out what the right price is for an instrument at a moment in time in a specified quantity. As you indicated, Jim, we try to make two-sided prices in literally hundreds of marketplaces in just about every asset class that can be traded more or less in an electronic automated fashion around the world, because somebody has to be sort of at, if you will, the tip of the spear. And that's kind of the idea behind Virtu, take technology and automation to provide that very, very important and we think valuable price discovery service to the marketplace. And so to get back to your larger question around, central banks and our central bank in particular, and it's just going to be a monumental rejiggering, if you will, and this is obviously a good thing for my business because there's going to be all kinds of portfolio shifting and realignment of interest as people get off the crack, if you will, of the Fed, as you say, over the last dozen years. And we've seen that in markets where you have these very sharp moves, and we see it as portfolios, rip through the marketplace, and we have to deal with them both as a principal and acting as an agent on behalf of our hundreds of clients around the world. So from a selfish Virtu perspective, it's obviously going to be an interesting time as these pockets of volatility kind of transverse the interconnected financial marketplaces. From a more micro perspective, in terms of like the debt capital markets and corporates and the treasury market here in the United States, I'm concerned because a lot of the regulation, the overreaction on the regulation coming out of the financial crisis in 2008, and you may find this a little surprising, I'm about to say, what I said was I think they handcuffed a lot of the large market makers, i.e. a lot of the big broker dealers, the big banks, in terms of capital restrictions and Dodd-Frank and some of the idiocy around Volcker that really had nothing to do with the financial crisis. And, we're going to see what happens over the next couple of years as a lot of, paper has to be, pushed through the system. So you're going to have air pockets. You're going to have people screaming there's not enough liquidity. You're going to have people blaming high frequency trading when it's got nothing to do with that. And really what it comes down to is just overzealous regulation and people trying to punish banks for things, frankly, that at least with regards to the treasury and the debt markets, that had nothing to do with the financial crisis. It's a long-winded answer. I hope I answered your question, but I kind of jumped around a little bit there.
Yep, very, very responsive indeed.
That's actually been a theme that we at Grants have been trying to tease out. We actually view the September 2019 repo backup as kind of a good indication of the problems of Dodd-Frank, because after the financial crisis, we decided that we never wanted banks to fail again. And the way we did that was by trapping tremendous amounts of capital and liquidity in banks. But it comes out when the market turns, that liquidity and capital stays trapped in banks and doesn't make it out to the markets. And it seems like we've had bigger air pockets in the last couple of years than we used to have pre-financial crisis. Has, I guess, the structure and the liquidity in markets become much more fragile than I guess it used to be?
Yeah, I mean, fragile in some markets, in other markets it not as fragile. I mean, obviously in the cash equities market where you have more centralized clearing and smaller positions get moved over periods of time, there's been, alternative players like Virtu and Citadel and others have jumped into the fray. In terms of the larger, kind of debt capital markets, fixed income, yeah, I completely agree with what you said, Evan. I think, the bad facts make bad law. We saw this with WorldCom and the Arthur Andersen collapse. In my view, like, Sarbanes-Oxley was a gross overreaction to that situation. And the same thing happened here in the financial crisis. Don't let a good crisis go to waste. Put all kinds of restrictions on banks because they're bad actors, even though like collateralized mortgage obligations had nothing to do with the treasury market. But trap a lot of capital in large financial institutions. And what ends up happening? Well, the lubricant, if you will, of the system is still largely going to be provided by the large banks and the broker dealers. You can talk about Virtu, Citadel, and all of our competitors, but if you aggregate all of us together, we ain't Bank of America, right? So, what the government has done in terms of handcuffing a lot of these large financial institutions, I don't think that we've seen the full implications of it. I think there will, as I said a moment ago, I concur with you, which is we will continue to see these anomalies in the marketplace, and regulators will scratch their heads and point fingers. But really, ultimately, it comes down to not allowing the marketplace to do what the marketplace does very well. And when governments pick winners and losers and put regulations and restrictions into markets where they don't really understand what the knock-on effect's going to be, that's what ends up happening.
Doug, the government securities market, the U.S. government securities market, is reputed to be the most liquid in the world, certainly the most important, everyone says everyone. But is there not something anachronistic about the way it's structured? I have in mind the 24 or so, I guess, rather one or two, more than 24 so-called primary dealers that are charged with implementing, two-way markets and helping the Fed implement its policy, right? So if the primary dealer system did not exist, would it be necessary to invent it, or could something else evolve spontaneously from entrepreneurs like yourself and others who would see a way to make a better market in this most important asset?
Yeah, I mean, absolutely. I mean, like, again, my analogy back to kind of the equities market, which, 30, 40 years ago, didn't function as nearly as fluidly as it does today. Why is that the case? Well, really, it comes down to a couple things. One is information. So in the equities market, we have a consolidated tape called the SIP. People say it's not fast enough, whatever it is. But at the end of the day, everybody has kind of the same real-time information with regard to every listed security and indeed a bunch of over-the-counter securities at the same moment in time. So real-time public reporting, like in the TRACE system, would ameliorate this lack of information. And technology has evolved greatly in the last 30 years. I mean, my company's only 15 years old, and we're responsible on many days for a fifth of the U.S. Equities market, right? So think about how drastically and dramatically the world has changed because of transparency, availability of market data, and technology. So why those tenets are not applied to arguably the most important marketplace, right, for all of us Americans, the government securities market, is a little bit, obviously above my pay grade, but you're right, it would seem to be certainly an anachronistic, clubby kind of system that goes back, 50 years, right, or longer.
Yeah. Doug, you are an alumnus of the private equity world.
Yep.
Most important transactor and facilitator of transactions in your role as a partner of Paul Weiss. And here you are, a champion of price discovery in the public markets. And what Evan and I have been observing is a seeming yearning of many, many people in finance to get out of the business of or the arena of price discovery, private equity being a prime example. There's a new grade of, a new kind of real estate investment trust that is not publicly. You kind of send in your money and sponsors may or may not make a bid come a time you want to get out. As someone who saw the private equity world evolving and growing and now becoming so big and important, how do you compare that worldview, that zeitgeist with the public world?
Well, it's interesting. I've been asked that, like just to extend the question, we're a public company and people say, are you happy you're a public company? Why are you a public company? And like, why did you do it? And, if you could do your life over again, would you do it? And it's interesting. You ask a great question because I started as a lawyer in 1990 and I saw the maturation of, the private markets. Obviously, as you mentioned, I was a private equity lawyer. We took private equity money at Virtu. And the interesting thing in the last 10 years is you've seen this graying of the line, if you will, between public and private valuations and investment. I mean, 10 years ago, you wouldn't have large asset managers like a T. Rowe, for example, or a Vanguard making meaningful private investments in, some of these unicorn style companies. So that just didn't exist. And so there was always those types of investments would have been done as part of an IPO or a follow-on. And again, why has that happened? Why have you seen less companies going public? Why are people delaying going public, et cetera? Some of it, again, not to beat a dead horse, and I'm not a crazy, anti-government libertarian type, but some of it.
Leave that to me, Doug.
Yeah, okay. Some of that. I'm a middle of the road guy. I don't know if there is a middle of the road anymore in the world, but I'm sort of a middle of the road guy. But yeah, a lot of that has to do with overregulation. It is not fun to be a public company. I mean, I'm a lawyer, so I can probably handle it a lot better than other CEOs. But the amount of of just brain damage and wasted money and effort is astounding, even for a smallish company like Virtu. I can't imagine what it's like at larger companies.
I'm going to take one historical exception to your statement that T. Rowe and the others would not be doing private things in a world of yesteryear. In the late 1960s, I was then 70 years old, 1960, there was something called letter stock. Letter stock was an inherently illiquid stock, and this was a bull market phenomenon, right? Because people had such confidence in the continued arc of rising valuations, rising prices. There was no need to worry overly about liquidity. So hence so now after a dozen years, let us call it, of manipulated downside, manipulated interest rates, rising valuations, and this word financialization, which I think is actually rather apt, financialization of everything we have. Lo and behold, T. Rowe, et cetera, et al, getting into private things because I think it's at some level of their financial brains, they think it's going to be fine. There'll never be a call for something that's in.
Yeah.
But
yeah.
No. Yes.
Yeah, no, I think there's definitely some validity to that. I'm thinking more from a company's perspective. When you have availability like that of capital, like why even bother trying to go public, right? It's sort of like, it's who wants the hassle? I mean, every time I read our 10Q, I have to sign this attestation for which I have criminal liability, and I've got, folks at the SEC now suggesting that I need to spend tens, if not hundreds of thousands of dollars examining like the impacts of climate change on little Virtu Financial, which is an electronic market making firm, right? It just makes absolutely no sense. We have disclosure on like, do we have war minerals and, in the Sudan in our 10Q because of some other, political nonsense that someone at the SEC wanted to put forth. And then you look at some of the proxy proposals
what about it?
now.
Do you?
I'm sorry?
Do you?
No, we're long zinc and short nickel right now. So, I mean, it's just the silliness of our government. I mean, the SEC has three. Now I'm going to go off on my diatribe. Okay. The SEC has three mandates. One is investor protection. Two is fair and orderly markets. And three is to make sure that we have the ability to raise capital in this country. Right. In my view, they're failing on all three of them because the market has evolved in a way that's fair and orderly. And now they're trying to get involved and screw it up. And all this SEC led by Gensler is trying to do is to make it more difficult for companies to raise capital. And it's sort of antithetical. Politicalization of the SEC and the capital raising process in the country is completely antithetical to the mission of the SEC. But this administration doesn't seem to give a crap.
What are some of the examples of things that Gensler is doing incorrectly now? Because I mean, I'm more familiar with some of the past.
How much time you got? How much time you got? Can we extend this for 2 hours?
Indeed. No one has a business like yours with all of its strengths and challenges. To succeed, you need a hiring partner that adapts to your needs. You need Indeed. So it's a hiring platform where you can attract, interview, and hire all in one place. Instead of spending hours on multiple job sites searching for candidates with the right skills, Indeed's powerful hiring partner is one that can help you do it all. Find great talent faster, time-saving tools like Indeed Instant Match, assessments, and virtual interviews. With Instant Match, over 80% of employers get quality candidates whose resume on Indeed matches their job description the moment they sponsor a job, according to Indeed Data Us. Now, Indeed makes it easy to start hiring. I mean, you want to hire, and you ought to hire, and this helps you to do just that. It takes 10 minutes or less for most small and medium-sized businesses, employers, to post a job according to Indeed data. That's a source you cannot quarrel with. So start hiring now with a $75 sponsored job credit to update your job post at Indeed.com/grant. So claim your $75 credit now at Indeed.com/grant. Indeed.com/grant. Terms and conditions apply. Of course, pay per qualified applicant, not available for all users. Need to hire? Well, you need Indeed. Join more than 3 million businesses worldwide that use Indeed to hire great talent fast.
Yeah. Yeah. I mean, look, what I would say is the SEC has become like a political apparatus. So examples are, I just mentioned one of them was, this long preliminary proposal they have out on climate change. I mean, there's always been the concept in the 34 Act, and I've learned this in law school and I live it as a CEO, that you need to disclose what is material to a reasonable investor. So if issues around carbon and climate change, et cetera, are material to an investor in Virtu Financial, then they'll be included in my 10K and 10Q. I don't need that level of detail prescribed for me as a fiduciary or an executive officer of a public company. So why is that proposal out there? It's obviously just a left-wing political agenda item that has been adopted by the SEC. More near and dear to my heart is the noise he's made around market structure and retail trading and payment for order flow and all this other stuff that he's been talking about. There's not been a proposal yet, but I understand one might be coming. And so essentially, they're acting on their own volition and without a plaintiff, if you will, without anybody complaining about problems, they're, interjecting themselves into public disclosure, i.e. capital raising, and now market structure. Whereas, it just seems to me this is, as I said, it's antithetical to the mission of the SEC. And it's, in my view, I guess I've been doing this 15 years and I was a lawyer for 18 years before that. This is far and away the most political and ineffective and actually counter-effective SEC that I've ever seen.
The real big dichotomy to me is, on the one hand, they want to do all these big picture things like climate change, but on the other hand, they're not doing simple things like prosecuting CEOs who appear to be breaking securities
Exactly.
law. And that drives me crazy.
Exactly. I mean, like all this stuff around the meme stock, Robinhood, GameStop, AMC, like the market structure worked fine. People put their money up, they invested, there was continuous price discovery, no one defaulted, everyone got their, trades confirmed, et cetera, et cetera. So there's nothing wrong with the market structure. What's wrong is there were obviously criminals in chat rooms and whatnot. The old boiler room, you guys have seen it for a long time, and it's kind of what was happening. There's no reason those stocks went to the moon and back down. Those are the actors that they should be going after, not attempting to pin this on like Citadel Securities. They're my biggest competitor. They did absolutely nothing wrong. They're an amazing firm, performed their services and provided great two-sided prices. I know because we compete against them every day, but yet they're vilified by the government. And then there's all kinds of conspiracy theories about how they conspire with Robinhood. It's nonsense. It's nonsense. And rather than the SEC stepping up and saying, look, it's nonsense, the marketplace performed the way it performed, they kind of don't say anything. And they come out with this GameStop reports that's kind of, political because they don't want to let Citadel off the hook. It's just not the way to run a railroad. So as I said before, it's become this political organization as opposed to this regulatory body. And I think that's just a shame. It really is.
Doug, do you have any thoughts as to the next possible big problem in the public marketplace? Way back when you could see the excesses building, of course, in residential real estate. You could see the non sequitur of some of the value propositions advanced in these structured mortgage products. And that was a thing in 2004, 5, 6, 7, 8, 9. What about today? I mean, is there other particular pockets of the market that strike you as especially problematic?
Yeah, I mean, I think history tends to repeat itself, Jim. So I don't, a lot of the stuff around like, crypto and some of these meme stocks, I think they're going to get headlines, but I don't think they're systemically relevant. I mean, there would be sad and unfortunate like retail investors that'll lose a bunch of money. And that's obviously not something that shouldn't happen. And we should have investor education, all that kind of stuff. But I think putting aside the politics of that, I don't think that's not going to be a systemic challenge because, as I said, all of those prices will be discovered and the trades will settle. I think, a larger issue, and you've pointed to it, is over the last dozen years of feeding off the Fed. And I've seen it myself in terms of just the change in the dynamic of the credit market. So there's going to be a lot of, quote unquote, investment grade debt, I think, that's going to need to get significantly repriced and puked out. So we could see, I'm old enough to remember, doing a lot of fallen angels from the mid to late 90s that needed to be like repriced and a lot of debt to equity kind of exchange, transactions and things like that. So if I was running a law firm these days, which I'm not, I would build up my insolvency practice and my restructuring practice, because I think we're going to see a lot of that. We're going to shift from, take all my litigators and make them into bankruptcy lawyers or something like that, because I think, unfortunately, we're going to see a lot of corporate defaults, a lot of double B paper quickly becoming C paper, and a lot of fallen angels, as we used to call them in the late 90s. I think that's probably the next wave that we'll see. I mean, you mentioned Elon Musk. I think he mentioned that some of these companies will need to go through a good bankruptcy, and we need to shake out some of those kind of companies.
I want to follow that up. 1 second, if you would, please, Evan. I want to follow up with the question, Doug, about whether you see some of this building now in the internal dynamics of the speculative grade debt market, or the so-called leveraged loan market, the tradable bank debt of companies rated speculative grade. Are you starting to see spreads widen? Are you starting to see bids become a little bit reluctant? Any signs of tension?
Not really. I mean, we tend to stay in the higher end. I mean, we make markets in investment grade ETFs and then corporates that underlie it. We, for obvious reasons, we'll trade and market make a lot of HYG, but we'll take a lot, which is the big high yield ETF, but we'll take a more conservative view, shall I say, with regard to that. So I think there you've seen, certainly within the high yield market, you're seeing more widening of spreads and more speculation, et cetera, which is natural, but I haven't yet seen sharp moves in the investment grade market. I still think that there's, because there's so many CLOs that have so much money, and this paper tends to get traded around, until you have some big seminal bankruptcy or liquidation event, which would trigger the marketplace, kind of like, if you sadly remember, I'm sure you do, what happened, to the Bear Stearns CLOs in 2007. Until you have an event like that, you don't really see it rippling through what we do in the capital markets world.
The Bloomberg's Barclays aggregate bond
index. This is so negative. Can we talk about something uplifting?
Well, when you get
you always like this, Jim? Come on, yeah.
When you get a crazy, libertarian anarchist on here to talk about things, you get
Yeah, you got me. You're guilty. Yeah.
Evan,
I'm just a markets guy. I just let the markets, leave them alone. Let them operate.
Yeah,
Come on.
Yeah, fair enough.
Yeah. I think that's a great sentiment. I've just not seen it in practice.
Yeah, exactly. It's amazing. Like, the retail, just I'll give you my public service message here on what we do. Like, the retail markets in this country, and Jim, you can speak to this better than I can, since I've only been doing this 15 years, but to the notion that we have zero commission trading and sub-penny price execution in the top 500 names in the United States, and then penny-wide execution in like another 7,500 with instantaneous guaranteed execution. And somebody in Washington thinks that somehow that needs to be improved is just shocking. Just shocking. I mean, there are so many things that need to be improved and looked at in advance of that. And we trade all over the world. And I can tell you that our system here and the deal that the retail investor gets in this country is so superior to any other country. It's amazing. Frankly, they get a better deal than our institutional investor clients get in this country. So the notion that Gensler and the SEC is looking at this is just crazy.
Who sang the song, the lyrics of which go, maybe Henry, you know this, but they saw paradise and put up a parking lot?
Yeah. Joni Mitchell.
Was that? Yeah. Joni Mitchell, yeah.
Yeah, so Gary Gensler wants to build a parking lot.
Yeah. Don't let a good crisis go to waste, and especially when Elizabeth Warren is telling you to go do something, I guess.
Yeah. But I see that you were quoted here, Doug, as saying that, I say here, this is my briefing paper from Evan, that although, as you can see in our supplemental materials, maybe this was a handout to the investors, the shared volumes from retail remain strong at over 2 times what they were in 2018-19. To us, this indicates long-term resilience of the retail investor.
Yep.
Okay. Has the retail investor truly been tried in the past dozen years? I mean, March 2020 was like 15 minutes.
Yeah, it's a good question. I mean, you remember, I guess the dot-com crisis or the dot-com situation where a lot of people got wiped out. And what I've always said, I think a number of structural things have changed. Obviously, you have proliferation of zero commission brokerages and technology. People can get access to markets on their handheld, and that didn't exist in 2000. That's the first thing. The second thing, which I think is actually more important, is if you look at the names that Fidelity and Schwab and all of our other great clients send us from retail investors, they really are much more Tesla and Amazon than they are, GameStop and AMC and, X, Y, and Z names that you never heard of. Whereas 20 years ago, you had like, Webvan and like, dogfood.com and all of these, and a bunch of telecom companies that had no revenue and a bunch of just companies, frankly, that shouldn't have been public companies, which is pure speculation. You have some of that today, but retail investors are actually buying, trading, selling, holding, real companies that have real revenues and real EBITDA. You can argue whether Tesla's worth $100 or $1,000, but it's not worth zero, right? So that to me is the difference. And so point we're trying to make to our investors, which we're not always successful with, is that this is not a cyclical change. It's not just because people were sitting home with their stimulus checks in their underwear in their basement with nothing to do. The growth of retail trading and self-directed trading predated the pandemic. It's when Schwab decided to match Robinhood and go to zero commission trading, and then E-Trade and Fidelity and frankly everybody else did. You saw a big jump in people interested in self-directed trading. And so that genie's not going back into the bottle is the point that we've made. Well, it may not be like, January 21 when you had these enormous meme stock names that were just trading huge volume. Like, that has come and gone, but still the bar has been raised substantially. It's been a real structural change in retail participation. That's the key.
But you had zero commissions coupled with 0% funding costs.
Yeah, true.
Now you only got one of those left.
Yeah, exactly. Yeah. So look, I mean, there's as I said before, sadly, people will exit the market and no longer be day traders, right? Maybe they should probably go off and try to do something else. But still, self-directed trading, which I think is easier, which is a better way to describe it than retail trading, I think is here to stay, in size. And frankly, just to be a crazy libertarian, I think that's one of the things that actually, frightens some of the quote unquote progressives down in Washington is, we've empowered this class of people to trade on their own. Well, now they should be able to vote stock on their own, right? Take it away from institutional, a lot of folks in Washington are complaining that BlackRock and Vanguard have too much power, right? Because they have all these proxies. Well, if you have 15, 20% of the market is self-directed, they should be able to vote their shares on their own as well. So they become much more important political force. Yeah. That's not good for some folks in Washington.
Yeah, they want victims. Not, entrepreneurs.
Okay, your words, not mine.
Okay. Evan, do you have anything else for our guest?
Yeah, I'd love if you just wouldn't mind opining. We had quantitative tightening once before. It ended in 2018 when the market sold off and the Fed kind of lost its stomach for delivering pain to the market. The Fed just began its latest QT on June 1st, and it's initially going to be at $47.5 billion and ramp up to $95 billion by September. What impact, if any, does this kind of have on, I guess, market liquidity and kind of, the business of making markets?
Yeah, it's a great question. As I mentioned before, I mean, it's, on one level, again, I don't want to cheer about inflation and whatnot. Obviously, there are some negative effects to that. But all of those assets rippling through the marketplace, it's like you throw a giant, not a pebble, you throw a giant boulder into a pond. And in this interconnected 24/5 global marketplace, it just has impact everywhere, which means that, you're going to see a rise in volatility proxies around the world, and you're going to see folks that are going to make large players making meaningful portfolio shifts, and they're going to need immediacy, which means they're going to need liquidity, which means that spreads will widen out, and means that that's opportunities for firms like ours. But that means you'll have a reduction in liquidity because you'll need it more. There's less participants, and that's going to increase volatility. So in a way, Evan, it becomes a little bit of a vicious cycle. So again, I'm not a macro guy, and I'm certainly not employed by the Fed, and they don't really care what I have to say. But it's not going to be the easiest thing to effectively puke out assets like that. I don't think that people understand how interconnected the marketplace is and the fragility of some of these markets, and liquidity comes at a cost. Right. So then there'll be an uproar about, oh my God, spreads are too wide. These firms did this and that. Oh, HFT, blah, blah, blah. But really what it all comes down to is, as you say, when you're trying to price reprice and readjust literally trillions of dollars of assets, there's a cost to it.
Well, Doug, this has been terrific, and what a pleasure to talk to you, and thank you for your information. People would say thank you for your time, which is indeed precious, but thank you for the decades worth of knowledge that you have delivered to us so much in your debt.
I appreciate it. Thanks very much, gentlemen.
Yeah. Evan, thank you for talking again. I guess you have to, but thank you anyway. Henry, pleasure to see you. And ladies and gentlemen, thank you for listening. Till the next time, this is Jim Grant on behalf of Current Yield Grant's Interest Rate Observer of the Air.